let's go ahead and get started. Good afternoon. My name is Carlos Ray. I am the Client and Community Relations Manager here at Merriweather and Williams, and I'm excited to welcome you to Bonding 101. Today, we had a great presentation for you centered around bonding and submitting your bonding application package. So we're excited to get to that. I know you didn't come to hear me talk, so I'll get through my few notes, and then we'll get right into our presentation. So just a couple of participation things, nothing too major. I know we all are like Zoom veterans by now. We've been on Zoom for a couple of years. So really just want you to use the Q&A feature to submit any questions you may have, and we'll get those to our presenters. And then just be an active participant, ask questions, feel free to communicate with each other in the chat. And we are excited about today's presentation. After we're complete the presentation for today, we do have a survey, quick survey we want you to fill out. You don't have to do it now. We'll definitely have this available for you at the end of today's presentation. But we want to just know how we did, how we're doing, if there's anything else you want to learn, any other topics that you want for future workshops. And so we just want that feedback from you. It takes like 2 minutes or less to fill out. So we would love if you could do that at the end of today's workshop. And with that, here's how you can contact Merriweather and Williams. Here's our phone number, email address. You can also follow us on social media on Facebook and LinkedIn. And with that, I will introduce our first speaker, who is Lourdes Landa, and I'll invite her up as I pull up her slides. So thank you for joining us this afternoon, Lourdes.
Thank you, Carlos. Good afternoon. I'm excited and happy to be here presenting Bonding 101 for you. It's a topic that I'm very passionate about. I've been in the bond industry for the last 34 years. I've worked on the insurance company side, on the surety company side, as well as the agency side. And I love helping clients. So let's get started. And I prefer that this be interactive. So if you have questions while I'm speaking about something, just type it in the Q&A, and we'll go ahead and go over your questions as we're going along the program. I already told you about myself, and next slide. Okay, so today we're going to talk about why bonds are required and beneficial. What are the differences between bonding and insurance? The type of bonds that are in the construction, the process of obtaining a bond, and what are the rules of the people involved in getting a bond, which are the producer, the underwriter, and the principal. And the principal would be you. And then, like I said, questions, I prefer that you just ask them as we're discussing a topic. So why are bonds required and why are they beneficial? First, bonds are required because a federal law was enacted called the Miller Act. In it, the Miller Act, you can go on to the next slide. The Miller Act requires that any federal job with a contract price of $150,000 or more have a payment and performance bond. I believe that if the contract price is under that, they can ask you for a payment bond only. Various states and local government followed and copied the Miller Act, and they created their own version, which we call the Little Miller Acts. And in California, whenever there's state funding and there's a contract in excess of $25,000, it's required that they have a payment bond. And in the private sector, it's not required. This is optional, but I do recommend with my GC clients that when they're working with a new sub and they're not familiar with them, maybe to bond the first couple of jobs just to get familiar with them. So this is a reason why some of the private jobs may require bonding. Next slide. Okay, well, what are you here for? How is bonding going to help you? Well, if you're going to work for the government, you know that the government or public entities, they have funding. They have money to pay you. Sometimes there's less competition for a job because not everybody is willing to go through the hoops and learn how to do bid on public jobs. If you like to work for the federal government, you can become an 8A contractor and you can get sole source contracts up to $4 million. So you don't have to bid against them, but you do have to be an 8A firm. And I also see, and I also recommend diversification between private and public jobs. When the economy is great, I know there's bigger margins in the private work and, it's less paperwork. But when the economy is bad and work dries up, it's not the time to start getting into public works. It's better to already be an expert and already have all your relationships built and have a backlog in the public works. And if you're a GC, it'll attract subcontractors and suppliers to work for you, because if there's a payment bond on the job, they know that they're going to get paid, because if you don't pay them, they can file a claim against your bond. And I've seen this before. Qualifying for a bond is the difference between keeping a job and not getting a job. I had a client that said, quick, I need to qualify for the $6 million job. They didn't qualify fast enough, and the job went to the next bidder because the GC just didn't have time to wait for them. And it's also a marketing tool that you can put on your website, on your business cards, on whatever you want to put. Let people know, hey, if you require a bond, I can bond it. You're just going to have to pay for my bond. We'll add that cost to my bid. Next slide. So now we're going to go over bonding versus insurance. Next slide. So first, let's define what a bond is. A bond is a three-party contract by which one party, the surety or the insurance company, guarantees the performance of a second party, the principal, that would be the contractor, to a third party, the obligee, and that would be the entity that you're working for, the city, the school district. Next slide. So insurance. Insurance is a two-party contract. Premiums create a pool for losses. Losses are expected. Insurance protects you, the insured. It makes you whole if you have a loss. And when there's a valid claim, you receive payment. That's a good thing because you need it. You had a claim. You had a reason to file that claim. And now let's go to what surety is. Bonding is very different. Next slide. So bonding is a three-party contract. Premiums are a service fee. They do not create a pool for losses. We underwrite bonds to a zero loss ratio. If the surety thinks they're going to have a loss on your bond, the best answer is thank you, declined, move on, we don't want your bond. Sureties do not care to increase their premium. They care to write good business where they're not going to have losses. That's what they care about the most. And bonds do not protect you like insurance does. Bonds protect others from you causing them a loss, because you're the one that can not perform or not pay people. Whenever a surety company pays out, you need to reimburse them for the loss that they had on your bond. So they will go after you for whatever they paid out, any legal fees, any cost associated with the claim, they're going to seek reimbursement from you. So with surety, you do not want them to pay claims unless you're the claimant. And with surety bonds, it's more like obtaining a bank line of credit. you must qualify for them financially. With insurance, you just ask for a quote, and if you're considered higher risk, you get a higher premium. And with bonds, it's not that way. If you're higher risk and you don't qualify, it's easier to say decline. Next slide. So let's go over the types of bonds in construction. So there's a license bond, a bid, performance, payment, and supply, and maintenance and warranty. Next slide. So with a license bond, it is required in order to obtain a license from a city, county, or state, and it guarantees compliance with local laws. An example would be your contractor's license bond, which is required in the state of California in the amount of $25,000. And if you're an LLC, you're required to post a $25,000 bond plus a $100,000 bond. That's the only entity that requires two bonds, and you must have them forever and ever while you have your license. Next slide. So the bid bond guarantees that the bid is submitted in good faith and that the contractor is going to enter into the contract at the price bid. And once they're awarded the project, that they're going to provide performance and payment bonds. Next. A performance bond guarantees performance of the work according to the terms and conditions of the contract. It protects the obligee or the party that you gave the bonds to from financial loss should the contractor fail to perform. The payment bond guarantees payment for labor and materials incorporated into the project by certain subcontractors, suppliers, and laborers. And the warranty bond, the maintenance warranty bond, it guarantees that any defects in workmanship or materials will be remedied within a specified time period. It's usually 1 or 2 years, and that'll be in the contract. And a supply bond guarantees that the supplies will be delivered per the terms and conditions of the purchase order. So now that you know what bonds are and what type of bonds we use in construction, how do you obtain a bond? What's step number 1? And the first step is to find a good surety broker. You want to find a broker that specializes in bonds only, not an insurance broker that dabbles in bonding. And the reason is you want someone to have a lot of insurance markets, that they're appointed with lots of sureties, and that they can explain it to you, kind of hold your hand and walk you through the process, explain what's needed now, and explain what's needed to get to your goals. If you only qualify for a certain bond amount right now, to tell you you only qualify for this now, but in order for you to qualify for, whatever X amount of dollars, you need to take these steps. And that's what a good bond broker is. And they're going to explain to you the whys of everything. Now, how do you find a good broker? Let's go to that. So first, to find a good broker, you get Meriwether-Williams is a very good source for that. There's also an association called National Association of Bond Producers. You can look them up on the website and try to find a broker in your state. But once you've identified who's going to work on your bonds, you go to your broker. They're going to ask you for the information necessary for the bond amount that you need or that you want or that you qualify for. They're going to send your information to an insurance company, a surety company, And once they review the information and they approve you, you're going to obtain a letter of bondability. That's going to say the limits that you qualify for bonding right now. Then you can go and identify a project that fits within those parameters. You request a bid bond from your broker. You submit your bid bond along with your bid to the owner, and then you get bid results. Hopefully you'll be the low bidder, and if you're the low bidder, when you get the contract, you submit it to your surety broker to obtain your performance and payment bonds. They get them approved, they send them to you, and then you submit them to the owner. Once you submit all the paperwork, you should get the notice to proceed and you begin your job. So what information is required in order to qualify for a bond? There's a credit-only submission, and I usually start the smaller business off with that. If you've been in business less than 3 years, and if you have good personal financial statement, usually, if you've been in business only 1 year, you usually qualify with good credit for up to $100,000 in bonding. If you've been in business more than 1 year, you can qualify for up to $500,000 with good personal credit. And if you've also completed a job in the $300,000 range, with just good personal credit, you qualify for bonding up to $750,000. After that, we need financial statements. So when we're bonding above $750,000, we're going to ask for a contractor questionnaire. We're going to need for business financial statements for the last 3 years, personal financial statement for all owners, a work in progress schedule to see what other projects you're working on that you need to cash flow. Next slide. These are nice things to have, but they're not always readily available. Resumes of key personnel, marketing material if you have any, letters of recommendation. These are really nice to have and very important. But remember, when you do a job and someone tells you how happy they are with you, ask them for a letter of recommendation. Nobody just, for the most part, they don't just do them. You have to ask for them. And they're really nice to have to send to your surety broker and to send to your banker. Let's see, a business plan if you have one, and also a continuity and contingency plan. This you don't need to have in the beginning, but as you're getting millions and millions of dollars in bonds, surety company wants to know who's going to finish the jobs if something were to happen to you. What is your plan? Who's going to take over? Who's going to complete the jobs and make sure that they don't have a loss? Next. Okay, so once the surety gets all this information, they are underwriting you based on the 3 C's. So what are those 3 C's? The 3 C's are character, capacity, and capital. So they want to know how you with character, they want to know how you have performed, what's your reputation. Capacity, can the contractor perform the work? And capital, do you have enough financial strength to fulfill your current and future obligations?
Hey,
Next
Lourdes.
slide.
Just wanted to interrupt. We did have a question from one of the participants. Do the letters of recommendations have to be from another public works project, or can it be residential project?
It's preferred from another public works project, but if all they've done is residential, then get it from residential. It's just a little extra that shows that you did a great job, because we know you've completed the job, but we don't know how great you are. We see that with those letters, and we see that as we build a history with you. But when you're brand new, I think anything is good. Any other questions?
No, that was the only one I asked you right now.
Okay, next slide. So to check out your character, the surety is gonna get references of, your primes or previous owners that you've worked for. Sometimes they get a bank reference, and they definitely get payment history with creditors. So they'll get like for businesses, they run a Dun & Bradstreet or Westlaw reports. Of the construction owner, they'll get your personal credit report, and sometimes they also do background checks. Next slide. So to figure out your capacity, or what they're looking for is, can you perform this type of work? For example, if you're a painter, why are you asking us to bond a roofing job? Or, they look at your work in progress report and see the size of jobs you successfully completed and what was your profitability. They also look at your work in progress report to see what's your total cost to complete. How much do you have to cash flow? How many jobs do you have to cash flow? Everything that you have, plus the one you want to bond. And they also ask questions like, do you have enough crews? Do you have the equipment? When we had this COVID supply chain issues, what do you have any of those type of issues with your materials? So those are the questions that the surety is going to ask. If you have a short deadline, can you meet the deadline? And can you get the materials on time? Next slide. So your capital, that's going to be your financial strength. They look at your financial strength by looking at your business and financial statements. They do require that they be on the percentage of completion basis. They look at your net worth and working capital. They want to see your bank line of credit or home equity line of credit, because they want to see if someone takes a long time to pay you, do you have a resource to get money quick so that you don't have any payment claims? Working capital and net worth requirement, they typically do 10 times your working capital and 10 times your net worth in bonding capacity. And your working capital would be current assets minus current liabilities. And your net worth would be total assets minus total liabilities. But that's as analyzed. The sureties discount some things. And if you don't qualify, if things aren't perfect or great, or you've had some challenges, there's alternative solutions to lack of financial strength, and that we will discuss later. Next slide. So quality of financial statements. There's 3 types of financial statements. The audit is like the highest level of service performed by a CPA. And this would be an example for, like, your publicly traded companies, your Amazon or Google, that kind of thing. That's what's required of them. A CPA review is the middle level of service. CPA expresses limited assurance that there are no material modifications to conform to GAAP, which is generally accepted accounting principles. This is what the sureties require. They require a CPA review on the percentage of completion basis. And these statements cost, I would say, anywhere from $5,000 to $20,000 a year. And you're lucky if you get 5,000. And a compilation is the lowest level. Essentially, the CPA just takes your numbers, puts it in a pretty format, gives it to the surety company, but they are not making any express assurances. Next slide. So the work in progress schedule, this is what the surety is going to look at, and they're going to see if there's any large cost and earnings in excess of billings. So that's you've done the work, but you haven't billed it. So why is that? They want to know if this is due to unapproved change orders. And are there any issues with getting these change orders approved? I have seen clients lose money because they did work on unapproved change orders. Those change orders never got approved and they lost money. Are there billings in excess of cost? In other words, you billed a lot up front. You haven't done the work. You owe the work. If you got a lot of money up front, do you have large cash balances? And if not, why? And is there a question? And is the profit margin holding? If not, why? And, the sureties have actually discovered fraud in a work in progress schedule where the profit was fading. So these are very important to have accurate numbers and to have good responses to the surety when they ask these questions. Next slide. So once the surety has reviewed all this information and they like you and they want to offer you a bonding program aligned, before they give you any bonds, they're going to have you sign the indemnity agreement, and which they often call the GIA. And the GIA is a contract between the surety company and the principal, the contractor, wherein the principal agrees to hold the surety harmless of any loss. So in it, the principal agrees to pay for premiums, claims handling expenses, including attorney's fees, and losses caused by the bonded obligation. So essentially, any expenses a surety incurs, you are agreeing to pay before you even get your bond. If you don't sign this, you don't get your bond. Next slide. So who must sign? The principal, which is a bonded entity, any affiliated entities that have the same ownership, and all owners of the company, including their spouse. I often get asked, well, I'm a corporation. Why do I have to sign personally? Well, surety companies require that. That's standard surety company practice. And in California, it's community property. So they require that the husband or wife sign. One time a contractor called me and he said, my wife won't sign. And I said, well, you have two choices. You either do bonded work or you don't, because you either do bonded work and she sign or you don't, because surety's required require your wife to sign. Well, he called me later on that day and he said, I've been kicked out of the house. My wife won't sign. So it can be a big problem, but it's pretty black and white, especially in the beginning. When you're a newer contractor, if you're worth millions and millions and there's a prenuptial agreement, then yeah, the surety can possibly, it's rare, but I've seen it where they waive personal indemnity or they accept a prenuptial agreement and they let only the owner of the business sign, but those are rare occasions. Next slide. So what is the cost of a bond? Bid bonds are free. Performance bonds, I would say they're 1% to 3%. And that's determined by the type of work, the financial strength, and how often you get your bonds, and also the financial presentation. You're going to get the best rates when you have the CPA reviewed financial statements on the percentage of completion basis. Payment bond, it's included in the performance bond. There's only one charge and it's on the total contract price. We do charge, warranty is 1 year is free, but after 1 year, if let's say you have a bond with a 2-year warranty, 1 year is going to be free, and year number 2, they're going to charge you for that warranty on year number 2. And the cost of the bond is an acceptable project cost. So you need to put it in your bid just as if it were materials for the job. It's job specific. So that's something that the owner should be reimbursing you for. And the bond premium is expected to be paid out of the first draw. So you don't have to pay for it before we release the bond, but we do expect you to pay us from the first draw. Next slide.
Okay. Before we have a question, one is based on the last slide. First question is, do you have to get it notarized? I'm assuming they're referring to indemnity agreement, or can a spouse sign as a witness?
No, it needs to be notarized, but now with technology, things have changed. So now the sureties will often do DocuSign, but they need, we get your driver's license so that the names match exactly how they are in your driver's license. So some sureties, not all of them, accept DocuSign. But a spouse could not sign as a witness. They have to sign as a person indemnifying.
Okay. The second question is the owner's signature the same as a seal?
No. A seal is extra. It's the owner's signature that's required.
All right, thank you. And that concludes the questions that we have so far.
Okay, thank you. So next slide. So let's say things aren't so perfect with you. Maybe you have a tax lien. Maybe you filed for BK before. Does that mean you can't bond? And the answer is not necessarily. There's alternative solutions to lack of financial strength. One, when you or maybe you don't qualify for, you want to qualify for more. So either you had issues in the past or currently have issues, or you want to qualify for more bonding than your financials qualify for. So to stretch, we can do things like bond back subs. They would bond to you under the contract with you. Use of an escrow or funds control company. Maybe take collateral, take a trust deed on your home if it's got a lot of equity. Provide the surety with cash collateral, irrevocable letter of credit, or we use programs like the federal SBA program. They have a program to help contractors bond. And the Meriwether and Williams program, which Jennifer is going to talk to you about how it works, but that's why we're here. We're here to help you qualify for bonding one way or another, or at least go down fighting and trying and doing everything we can to help you. Next slide. So what is escrow funds control? So it's a method that sureties use to offset the possibility of a claim against a payment bond. The surety requires that a third party manage all monies related to this job. The escrow company will receive the funds and pay expenses associated with the bonded contract, including labor, material, and bond premium. The service usually has a cost of 0.5% to 1% of the total contract price. And what they do, the reason why surety companies do this is that you don't, for lack of a better word, rob Peter to pay Paul. So that on the job that we're bonding, you don't use any of those funds to pay any cost on any other job. It's got to be all for this one specific bonded job. Next slide. And the SBA, how does it work? Well, it's a federal program, so it applies to any job in the country. It guarantees up to 90% of the bond to the surety. The federal government guarantees the bond to the surety companies. You must, to qualify for this, you must be a small business, depending on your NICS code. And some of them had like 45 million in average annual sales. So you don't have to be tiny to qualify for SBA. You must be current on your taxes or at least have a written payment plan. If you have no payment plan, then the SBA can't bond you. And SBA will help on single jobs up to 6.5 million and 10 million if you are a prime to the federal government. You do have to pay an SBA fee of 0.6% to the federal government. Plus, separately, you have to pay premium to your surety. They will go twice the largest job completed. So we always need to know what's your largest job completed. And if you have a home equity or business bank line of credit and you have availability to borrow money, they will count whatever is available to borrow as working capital in your business. Traditional sureties will typically give you bonding capacity of 10 times your working capital. The SBA will give you 20 times your working capital. So the SBA is a really good program sometimes to stretch. And next slide. So the roles of the producer, the underwriter, and the principal, what each party is responsible for. So the producer, that would be your surety agent. And they're going to be your primary surety industry contact. They're going to perform the initial pre-qualification. They're going to match your needs with the proper surety company. And they're going to communicate with the surety company on your behalf. They'll negotiate your level of capacity and your rates. And they're going to provide sound business advice and expertise for bonding purposes. So they will tell you what to do to get to where you want to go as far as bonding goes. They're a very good source of referral for like bankers, CPAs, attorneys, because we often network with experts in the construction industry so that we have resources for our clients. And like I said, surety bond producers, a lot of us belong to an association called National Association of Surety Bond Producers, and there's some resources there. I forgot to add it to my slides, but there's actually a bond class you can do online, and it's free. And you do it at your own time. And once you graduate, they also put you together with an agent and a surety company to help you get off the ground, and that's for small businesses. And next slide. So the surety underwriter, so their goal is to prevent losses to their employer, the insurance company. They're going to assess the risk, and they're going to extend surety capacity to the contractor based on the 3 C's: character, capacity, and capital. Next. And the principal, that would be you. Your job, your responsibility is to earn and maintain the surety's trust. You never ever want to lie to them because you're going to lose their trust. You're going to provide accurate, detailed, and consistent information in a timely manner. If there's any problems, you want to let your agent and the surety company know right away. They don't want any surprises. It's better to mitigate losses. Next slide. And that's it. Does anybody have any questions for me?
No, I don't see any in the chat at the moment, but I'll give everybody. Oh, I do see a question. Can I please have the surety website again mentioned in the chat or mentioned?
Yes. Do me a favor, if you want to email either Jennifer or email me, and I will get that for you. My email is llanda@mcgriff.com. And that's mcgriff.com. And I'll be happy, whoever emails that to me, I'll be happy to send them the link.
And then there's another question that says they would like information about the bonding company you mentioned.
The bonding company?
Yeah, that's all the question says. I'm not sure if it was the NA
NASBP? Oh yeah, that's the association, National Association of Surety Bond Producers. So yes, I'll be happy to send that link to you as well. Just send me an email and I'll send you that link. It's gonna be the same stuff of information we just went over, but you can do it on your own time, and it's probably more comprehensive.
The next question is, do you have to use any of your HELOC for collateral or just show the surety company the amount?
Do you have to use your what?
Your HELOC or HELOC?
Oh, no. So it's it's like a bank, right? When you go to the bank, the more money you have, the more you're qualified for borrowing. The less money you have, the less you'll qualify for borrowing. We just want to see that you have a ton of money or as much money as possible. We want to show the surety company. The more money you have, the least the chances are that we're going to have a payment bond claim, because first you're going to resort to the money, the cash in your business. And if you run out of the cash in your business, you're going to resort to your bank line of credit or your HELOC. So no, typically those are not put up as collateral. It's to show that you have resources.
Right, and
now there are some situations where you have to put up collateral. Like I have a guy that has a tax lien. It's like a $400,000 tax lien. They're trying to get it cleared up with the IRS, but it takes a long time. They don't have a payment plan. They're trying to just get it get it to be taken off because they've been making payments. So because they have no payment plan, I cannot put them in SBA. And this contractor was doing a job there wasn't bond assistance available, so like this program has. So what we had to do is take a trust deed on his home. So it depends on the reason. Do we take collateral? Sometimes, yes, we do. But that was the only option. It's either you take collateral and you qualify for this bond, or you don't do this job. But we try to avoid taking collateral. Is not the first thing we look at. We try to do the bonds without taking collateral, without doing escrow, without doing the bond assistance. But if we need to get you to qualify, then we go and use all our resources. I personally have used SBA and the Meriwether and Williams bond assistance programs together to help some contractors qualify. So I use every resource I have in order to help you qualify, but that's only if it's necessary.
Okay, and we have a few more questions. So the next one is, do technology companies in the tech space have to get bonded?
Some cities do. I've seen it. We do it. Not everybody.
All right, thank you. The next one is, can property appraisals be used to show net worth to increasing bonding capacity?
Definitely. The sureties look at Zillow, but those are not very accurate to have an idea when you give your personal financial statement. But yes, if you have an appraisal, anytime I know one of my clients has an appraisal, I tell them to send them to me, because that's verifying this property value. That's verifying their net worth. And the sureties want cash is king. The more cash, the better, because that's your working capital. Equity in real estate is net worth. But at the end of the day, if you ever have a claim and the surety wants to get reimbursement, the first thing they do is put UCC filings on your assets, which would be real estate, right? So So yes, all that's valuable to the surety. One, they want to know you have working capital, cash to pay you, to be able to pay your bills. But two, they also want to know you have assets that they could put a lien against should they pay out on your bond and they need to get reimbursed.
All right, thank you. And the last question is, how can we find out more about the SBA guarantee program?
So you can go on you can go on the federal website and find out about it. But I think the easiest way is to have your surety agent explain it to you. But that's something public. You can just go on there, you go on their website, and it has a list of agents that are, approved with the SBA to do SBA bonding. So just Google SBA bond guarantee. It should take you to the federal website.
And sorry, I just had one last one come in, sorry. Can you please clarify once again the bonds for LLCs that are needed?
Yes, so in California, to get your contractor's license, you need a $25,000 contractor's license bond. That's it. But there's one exception. If you're an LLC, they require two bonds. They require one bond from the $125,000 bond, and then another $100,000 bond. That's only required of the LLC. And that's to make sure that you're gonna pay like wage and welfare benefits. So
Okay.
if a new business is coming to me and they tell me they're an LLC, I would say, unless you want to pay for this extra $100,000 bond every year, go change your entity. Otherwise, you're always going to have to pay extra. And if you're trying to be an LLC to limit your exposure, your liability, I mean, you can limit it with the public, but with the surety company, you're not going to limit it. And you're not going to limit it with a bank.
All right. Thank you, Lourdes. I think that completes our section. It does say to confirm this only applies in California. I would suggest that you check the law. Lourdes is based in California, so I would suggest you check the laws in your state or in your area just to confirm that, unless you have any other knowledge, Lourdes, you'd like to share.
Yes, for that contractor's license bonds, go on california.ca.cslb.gov. And there you can look up the bond requirements for licensing in the state of California.
Okay. And would you recommend they do that if they are in another state outside of California?
Yes, I would recommend that they check their local licensing guidelines. As far as the licensing goes, I'm more familiar with California, but yes, I would definitely recommend they check that, because $100,000 bond costs $1,500 to $2,000 a year. So are you okay with paying that every year as long as your business is in place, just because you're an LLC? So usually smaller business don't have a lot of money, and that's a big expense.
So do you guys mind if I chime in? This is Jennifer.
No,
One of the things they're trying to do with the LLC is get a protection between their personal and their business assets. An S corporation in California would do the exact same thing and would not require the extra LLC bond, and would allow them to have the same kind of protections that they're trying to get through their personal assets. So if you can switch from an LLC to an S corp, and it will do the same thing for you, if you want to avoid those extra costs.
Yes, most of my sophisticated clients are S corp. Some of them are C corps, but most of them are S corps.
All right, thank you. So thank you, Lourdes. We appreciate your time and your expertise of talking to us about bonding and everything that goes into it and how to qualify and everything that we need to provide for bonding. So now we're going to transition, and Jennifer, you jumped in right at a great time. We're actually going to transition into the second part of our presentation. So now that we know all about bonding, we're going to talk about how to actually successfully complete a bonding application package. So Jennifer is going to talk to us about that. And so Jennifer, it's all yours.
Hi, good afternoon. I'm Jennifer Elmore. I'm the program manager with the City and County of San Francisco Contractor Development Program. And we're going to kind of go over a little bit. There will be some repeating of what Lourdes so fantastically educated us on. And so please forgive me if there is some duplication, but I figure it's better to have a duplication than not. Next slide, please. So the topics that we're going to be covering is why is it important? And as Lourdes explained, bonding is vital to the growth of the contractor's business. The surety underwriting process provides guidance, discipline, and benchmarking to help your business. And if you think about it this way, what Lourdes can offer you when she goes over and underwrites and pre-qualifies you, it's a free service. Surety companies vet your company and provide insight and suggestions where you can make changes to improve your company. They are your advisors and instrumental to your business. Surety brokers, surety companies, bankers, CPAs, they're here to help you grow your business. One of the things that's important is qualifying in advance allows you to incorporate your bonding rate or premium into your bid. Some of the documents that we're going to be reviewing today are a quick application, which Lourdes mentioned, based on personal credit of owners versus what is a full submission based on the business and personal credit. We're going to talk about the limitations of a quick app as it is project by project and limited in amount. It also does not allow for growth or for an increase in bonding necessarily. Full submission requirements, we'll go over the completed contract questionnaire, the bank inquiry form, year-end statements, work in process, work on hand or work in progress schedule, personal financial statements of all owners, proof of insurance, project-specific documents. So, timing. Surety companies take 2 to 3 weeks to review your paperwork for a full submission, which is why we say the timing is really important and that you get, once you know that you want to bid on a project, you bid as quickly as possible. Once you've established a single aggregate bonding line of credit, please submit to the surety as early as possible for them to review the specific project. Next slide, please. Having your documents in order will give you an enormous advantage. Surety companies often don't meet with you, but get to know you through your documentation. So a complete submission that does not call for additional questions or information is easier to process. As an example, if you are aware that you have debts on your credit report, then an explanation of the debts and your plan to alleviate them may take a red flag for the surety and make it more palatable. Can expedite the process. A complete submission that does not raise additional questions with references that respond quickly may expedite the process so that 3 weeks is now 2 weeks or maybe even a week. It's important because the surety application tells a story of your company in all aspects. As we go through the application process, you will learn how. Next slide, please. So what documents do I need? So the first document is the program application or the surety questionnaire. Now, surety companies don't mind using other forms. And so please click on the link. So as Lourdes discussed, this form is an overview of your company and speaks to the 3 C's, character, capacity, and capital that Lourdes reviewed. So what the form gives the surety company is general information. So it gives you in the top, the general information, then it gives operational information, the type of business, where you operate and what is your territory. And when they talk about that, they're talking about, for example, if you're in Los Angeles or any other regional area, are you staying in that area or are you flying throughout the United States? Are you flying from Florida to Minnesota to California to Nevada? What types of projects are you operating? Are you doing different types of projects or are you staying within your wheelhouse? Do you have other companies that may impact this company from a monetary and or a time standpoint? If you could go down a little bit, then they're asking for historical information. So they're going to ask business and personal regarding your bonding history. So that's where the surety is listed. Any disputes and or tax liens that may cause your business problems. How is your business structured? How long have you been in business? And how long have your key employees been with your business? This kind of information goes to show your longevity, and turnover can show employee dissatisfaction or that there's something going amiss in the country. Do you have a succession plan in place? If something happens to you, and is it backed by monetary considerations? If you go down a little bit, please. And that's called Key Man Life Insurance or behalf of key employees or Man Life Insurance. And then the next section is credit information. What are your established business relationships? Are they long-standing? What are the terms of those relationships? They're going to look at your accounting and financial. Are you running your business based on GAAP? Or as Lourdes talked about, general accepted accounting principles? Are your statements accrual or percentage of completion? Accrual accounting method where revenue or expenses are recorded when a transaction occurs versus when payment is received or made. Percentage of completion method recognizes revenues and expenses in proportion to the completeness of the contracted project. The answers to the form give insight into whether you are utilizing your accounting as a project management tool. Are you tracking project costs internally and course correcting as the project progresses? Are you using your project cost tracking and incorporating the cost production rate into new and upcoming estimates? Then it goes into the experience. What has the company accomplished to date? What size backlog? How much annual volume? The surety companies compares the answers that you give on the program application surety questionnaire to your financial report, banking data, financial statements, LexisNexis search for accuracy and truthfulness. Red flags can come from making mistakes and having to explain the discrepancies to a surety's satisfaction. Can we go back? Okay, so the next we look at is a bond request form, which is a project-specific form. The form is a cheat sheet for the surety showing that you know the project and you've gone through the general terms and conditions and the specification. Surety will ask for the specification and the general terms and conditions. Surety companies want you to bid and be successful, but they also want to make sure that there is not something harmful in the specifications. For example, liquidated damages may be $10,000 a day on a $200,000 subcontract, which can bankrupt a small contractor. Things the surety is specifically reviewing are liquidated damages, length of the warranty, which Lourdes talked about, retainage, percentage, how does your estimate compare to the engineer's estimate, and the reputation of the owner, to name a few. The cost breakdown sheet is also a project-specific form. This form is an overview of your estimate showing the surety that you have sufficient profit and cash flow to complete the project. The surety bond program added bonding so that contractors were aware and included in their bids. If you have a 10% profit project but forgot the cost of the bonds, your profit is immediately reduced by the premiums. So we want to make sure that you include that in your bid or as a line item, and that's why we're asking you to pre-qualify in advance so you know your bonding costs. Work on hand schedule, or it's also called work in progress schedule. This form is based on percentage of completion accounting method and shows the surety the details of each contract stage of completion and profitability to date, as well as in the current period of reporting. The work on hand, or WIP, work in progress schedule, can give an accurate measure of exactly where you stand financially with regard to each project and totaled for the company as a whole. And please ask questions if I'm going too quickly. Next slide, please. Okay, bank inquiry form. Oh, sorry. Okay, so the bank inquiry form, this form is a review of your current cash balance and should be prepared by your bank, your business bank. If your bank will not prepare this form, then you can provide 3 concurrent months of bank statements for the company. Some sureties ask for bank statements from the owners in the company. We just wanted you to be aware of this form if you haven't seen it before. So this is the sample, or COI, or a certificate of insurance. The surety wants to make sure you have insurance and that it will be in place. They do not want to be listed on your insurance. They don't want to be named insured. They are ensuring that you can comply with the project terms and conditions. Personal financial statements. The term personal financial statement refers to a document or a spreadsheet that outlines an individual's or a married couple's financial position at a given point in time. The statement typically includes general information about the individual married couple, such as name, address, along with a breakdown of total assets and liabilities. The statement can help individuals or married couples track their financial goals and wealth, and can be used when they apply for credit. Personal financial statements are usually required for anyone with 10% ownership of the business or more. And just as a reminder, this is just your personal assets. Your business assets would not be included in this. Next slide, please. Okay, so now these are documents that you need. And the first one would be a balance sheet or a business financial statement. And Lourdes went over really well the types of financial statements. But what we're going to go over is the balance sheet, which is detail the business assets, liabilities, and owner's equity. The balance sheet is a snapshot of that date that displays the company's total assets and how the assets are financed, either through debt or equity. It can also be referred to as a statement of net worth or statement of financial position. The balance sheet is based on the fundamental equation, assets equal liabilities plus equity. The income statement is one of a company's core financial statements that shows their profit and loss over time. So it's a running total. The profit or loss is determined by taking all revenues and subtracting all expenses from both operating and non-operating activities. Aging schedules, and this would be accounts receivable and accounts payable. So the accounts receivable aging is the process of distinguishing open accounts receivables based on the length of time an invoice has been outstanding and obviously unpaid. Accounts payable aging report is a critical accounting document that summarizes the bills and invoices owed by a business broken down by a vendor and due date. Personal tax returns, business tax returns is used more for bank lines of credit. Surety companies prefer CPA statements or at least internal statements based on accrual or percentage of completion method. Additional documents that may be required if applicable, next slide please, are resumes of key personnel. Not necessary, but it does give more insight and tells more of a story about your business. Sureties will ask for the resumes of all the company's owners as well as those of the key operating personnel. The surety is looking for each individual's position in the company and the responsibilities each of them hold. Sureties will want to know the amount of time each person has held the position and the time and experience they have in the industry. This speaks to your company's depth and breadth of experience, especially if you are just starting out as a business, but have been in the construction industry for a long time. References. Now, references can be broken down. Credit references. This is for suppliers, subcontractors, and establishes your relationship and payment history beyond them looking at the standard AP aging. Banking information and references. This is what they get from your bank statements or the bank inquiry form, or from an existing established line of credit with a bank. Reference letters from show how your company has established excellent relationships with prime contractors, owners, subcontractors, showing a pattern of satisfactory work. They're also looking if you are incorporated for articles of incorporation. The surety only needs the declaration page of your company's incorporation. The surety will check to see if your company is good standing. Partnership, if applicable, to see the terms and conditions of the partnership, especially profitable distributions and dissolution of the partnership. Family trust. If your personal assets are in a family trust, the surety may ask for a copy of the trust and include the trust in the indemnity agreement. And then Lourdes has already discussed this, but I will go over it again. The indemnity agreement is the surety security against loss or damage. All sureties require some form of indemnity. Most will require full corporate and personal indemnity of all the owners and their spouses. Indemnity agreements are required because they obligate the principal, you, to repay the surety for any losses the surety pays out on the bond. Generally speaking, the indemnity provision in the agreement grants the surety the broad legal right to recover from the indemnitor whatever it pays on the principal's behalf under the related bond, as well as those amounts for which it remains liable. Next slide. Okay. Just one more thing about the indemnity agreement. California is a community property state, so that your spouse does need to sign. And because a surety companies underwrite for zero losses, it is in their best interest to have your company succeed. As the surety company makes money and you make money, sureties do not want your company, your personal assets, or your house. If they provide a 100% guarantee of performance and payment to an owner or prime, and there is a loss, their underwriting, the surety company wants to be indemnified or make whole. In other words, they don't want your money. They want to make money, and if you succeed, they succeed. So timing. The underwriting process takes time, and a complete application with answers to anticipated questions will be usually reviewed first, as it is easier as it is easier for the underwriter. Obtaining surety bonds requires a significant amount of underwriting, meaning the surety providing the bonds needs to analyze the details of your bond request, the case, and any other applicable information that is provided with the bond application. And we usually see a complete submission take around, as stated before, 2 to 3 weeks. So, next slide, please. Are there any questions?
No, I don't see that any that have been entered into the Q&A or the chat.
So one of the things we want to make sure and make you aware of is the whole point to Meriwether and Williams bonding programs are that we are here to help you walk through the application and to make sure that you complete all forms to your satisfaction and answer any questions. We have a great relationship with Lourdes, and she is an amazing asset that we've been able to work with. And a lot of our contractors that we've worked with have been able, she's been able to get bonding for them under interesting circumstances. Can I say that, Lourdes? Oh, I think
She may have stepped away, but
I got there I go. Yes, we have worked on some very challenging cases, but that's why the program, Meriwether and Williams program, is very important, and I congratulate you that you're already part of it. like I said, I use whatever resources I have whenever there's a challenge to help you get bonding. And I reach out to Meriwether and Williams all the time. And thank God we also have the SBA program, because they don't have bond assistance in every state. But every program that they use, sometimes I've had to use the SBA and the Meriwether Williams program together. So I'm very grateful that they're very different programs and that I can use them together. And I congratulate you for being here, because I've had clients that have taken from their first bond to them becoming, you know, doing in the $50 million range revenues and becoming ESOPs, and all thanks to the Meriwether and Williams assistance.
Yeah, great. Thank you guys. So I think that will end our presentation for today. Let me see. I think I just saw a question come into the chat. Let me just double check. Okay, I do have one question. I'll just shoot this to either one of you of our presenters today. It says, I've been in business for about a year. Previously, I heard that the max that I would be able to qualify for is $100,000 bond. Do you know how much the city of Charlotte requires for a bond? Is it based on the cost of the project alone, or are there basic minimum bonds that most people should have?
So I'll start and then allow Lourdes to you know, step in if so bonding follows a contract or a project. So for example, if the project, and it's usually the amount that you would bid. So if the project is for, the engineer's estimate is $100,000, but you want to bid 150, that would then be the bond amount.
Yeah. I have some additional comments to
Perfect.
that. So if you've been in business less than a year and good credit only, you can do up to $100,000. Okay. But that's not taking into consideration that you're going to do a job with someone with a city or county or public entity that has a bond assistance program. When we add, and that's not taking into consideration your financials. So one, if you have good financials, we need to see them. Two, when we do credit only, we don't even see the financials. Two, we don't know your experience. So if you have a resume, if you said, yeah, you know, I've completed these jobs while, you know, I ran these jobs while I was with my former employer, we take that into account. Not too long ago, I did a $1.6 million for a brand new entity, and we were able to do it because we had the Meriwether and Williams bond assistance. I forget, I think it was maybe for the city of LA or county of LA. But so I'm giving you ideas, but those are just guidelines. If you want to know for sure if there's something you can do, the only way to know is to look at your whole picture. I also did a $5 million job one time for a brand new company. We were able to use SBA and the City of LA Bond Assistance Program. And the reason we were able to get them a $5 million job is I had the guys go out and get CPA financial statements. They're working capital qualified, and the SBA took into consideration completed jobs that these partners had done when they owned other construction companies that they owned. And now these three partners came together. So it's never black and white. It just depends on the situation. So please never assume you cannot bond something. It's better to ask. And then I'll tell you why I think you can't bond it. Or once I see your financials and look at the big picture, then I can tell you why you can bond it or how we can try to do it. I never promise you an approval. I just promise that I'm going to try. That's all I can do because I don't know what the information is going to look like.
All right. Are there any more questions? We have a couple of minutes left. Okay, no, I don't see any. So I just want to thank you, Lourdes and Jennifer, for your time this afternoon and all the wealth of knowledge you've shared. I see that people are reacting in the chat and saying thank you very much and really appreciating all the information. So I just want to, on behalf of everyone in attendance, say thank you for being here with us this afternoon and sharing the information that you have. The last thing I wanted to do is mention the survey one more time. Just going to put it back in this on the screen so you all can see it. Please feel free to fill that out, give us some feedback. It should take about a minute, 2 minutes maximum. There's a QR code there as well. Please fill it out for us. We would love to get your feedback so we know what to do for the next trainings and different topics you may want to hear about coming up. And we will have another session next month that we should be announcing next week. So we're really excited about that. But we thank you all for your time. I know we're all spread out in different places, but thank you for your time. Thank you for the dedication to your business. This is only going to help you grow as a contractor and as you grow your capacity and your overall business, and hopefully leads to award of more contracts and more contracts and more contracts. So that's what we're all about, is here helping you as small business contractors grow, get the information that you need to be successful when you're pursuing contracting opportunities. So thank you all again. I hope we all have answered your questions. We will be providing the PowerPoints that you saw today. We will have a link to watch the recording, and then the additional documents that were in some of the presentations, you'll be able to access those as well. So just thank you all. Have a great rest of your day, and we hope to see you at our next training. Thank you.